So, all right, well, let's go ahead and get started. We are here on this last trading day of April. So can you all see my screen okay?
Yeah, I think so.
I see.
Oh, now,
Here we go. We're switching.
yeah, now
there
we
we
can
go.
see. Now
There
we can
we
see your
go.
screen. Yes.
Okay, well, here we are. Is it time to sell in May and go away? We're going to find out a little bit about that today, because April is seasonally bullish, but we've got, like the Nasdaq and S&P, we're trying to hang on. They were really moving up today after a tumultuous kind of week with all the earnings and everything. But so you got this kind of sell in May and go away. You can see that slide there. It's comparing kind of the potential going from October to May compared to when we switch over and kind of go from May until October, just those percentages kind of for the S&P and the Nasdaq. And they've been doing this for a long time, kind of a seasonality look there. So we want to talk about that. And let me see if I can get this going. There we go. I was showing this the other day, and I was talking about how this was the pattern for that Bespoke puts out. This is the economic data, the most frequent misses to expectations. So we've got that all, and we've got that coming here for the summer. Pretty amazing seasonality there. This is for missing expectations, on the news, the economic news type event. And so coming down kind of goes with our kind of sell in May, go away if that's the case. And then we've got the kind of turnaround there in July. Is that going to happen? We'll talk about kind of what's going on. Here's that jobless claims that came out yesterday, and that kind of downturn. But you can kind of see how it was moving up. Now we're coming down. What does all that mean? I don't know. Here's the GDP came out yesterday, moving down again. We had those 2 down quarters last year that they didn't actually call a recession when they kind of changed the rules. We'll see what all happens, but basically, those were 2 down quarters. We had this recession over here. That was COVID. It made a lot of sense. We've never gone through something like that as a country. So definitely going through that recession where those 2 quarters of GDP were negative, but you just kind of see this kind of rubber band effect. And then the whole question is, well, are we really going to go into this recession here in this last part of the year of 2023? What exactly is going to happen? We don't know, but we're going to be trading it. We're going to be finding out and trading live. Well, we've come through a lot of earnings, just a few earnings, not a lot, hasn't had a big impact on the market. Ha ha ha. But you can see why, a lot of big cap stocks that have come out already. We've got this big Apple, getting ready for next week to bang off May. That will be a lot of fun. So we'll talk about that. And then this is just kind of where we are just in the last, if you look at the last 5 days, we've got these sectors. And so I really want to kind of today on this Ask the Pros, really kind of dive down into these sectors because we've got some real experts here and talk about, well, what are we going to see in, May, June, July, August? We've got communication services come on, the best performing one over the past 5 days. We've got, industrials, materials lagging, energy lagging, just kind of, this is what's happened, oversold, overbought kind of areas. If you follow that kind of look and analysis and this whole trading range. I know Roger's talked a lot about this, Jeffrey's talked about this, just kind of like, hey, well, can we just go nowhere, for a while? And is that kind of what we've done? Where are we going in this market? It's not like that's a pretty sideways looking market to me as well, even though we had this bear market here 2022. So let's find out. Let's find out, guys. What do you think? With all of that news coming out, Roger, you go first. How should traders process all of this, or is there a seasonality to all of this? What do you think?
Well, I'll get into all of that when we get into my topic, but right now, I think right now, and let me just show you really quickly. It's easier said than it's one of those things where picture's worth 1,000 words kind of thing.
Mm-hmm.
If you look at the bond market right now, and this is really based on that, I'm not really going very far off typical economics 101 here. But if you look at the bond market, the long bond, you'll see that it's been very stagnant and hasn't really gone anywhere for a while, right? And again, I'm not really looking at things from a micro view. I'm just kind of just looking at it from a big picture. Now, so, and then look at the Dow Jones for a while now. It's just kind of stagnant, not really going anywhere. And small caps too. I mean, sorry, small caps too.
Mhm.
Let me just put that in there. And it all goes, I mean, look at that. That's kind of where I was going. Very stagnant, not a lot of directional bias. And what the stock market typically gets its movement from the bond market, and the bond market typically gets its movement from the currency market. But we don't need to go into currencies because we'd be here for 3 days, me explaining things to you that really wouldn't be relevant to the stock market. The point is, if the bond market, especially the long bond, if the long bonds become stagnant, the stock market sort of takes directional bias from that. And even the earnings that we've had, which so far have been about twice as good as they were expecting, and I'll get into that as well a little later. I think one of the things we're seeing right now is going to be a lot of stagnation. And you might or might not remember this, but a while back in the show, I said everyone's expecting like a big rally or a big crash. But what about just stagnation where we just don't do anything? I mean, so far, the index that's been, Kathy Woods, the most awful trader in the world. And I could say that here. We're amongst friends. I mean, look at this. I mean, look at this. Look at the level of stagnation she's had.
Yeah.
Hey, at least it quit going down.
At least it quit going down. We did call that one right back in May of last year. But this leads the market. This made a 52-week high and made the highest high a year before the rest of the market, and then just fell apart. So this to me looks like what we're going to be seeing in the U.S. stock market. Now, that's not a bad thing. Great for option sellers, great for swing traders. It's a good thing for guys like us. Not good for your 401k though. But I think a lot of what we're seeing, is squarely based on the fact that the bond market isn't going anywhere, and I think it's throwing us off by a lot. And I think a lot of people they're waiting for that drop, for the second shoe to drop. But the problem is we've had everything already priced in, unless there's something completely new, different, drastic, something that none of us have taken into account. And that's talking after COVID, after China, after Putin, and God only knows what else happened to us in the last 3 years. Earnings took a 50% bath. I mean, I was reading the estimates for what was it? I think it was Meta. And we're only looking to be down 25% from last quarter. What? 25%? If you said that 3 years ago, that would have been like a headline on CNBC. Now it's like, well, so is half the other companies. So I think Celeste, before we move on from this topic, I think it all goes back to exactly what you, Jack, and myself were talking about. Where was it? It was on the just a few days ago.
Roundtable, yes.
Midweek roundtable. Jeffrey, you weren't there, but basically, in a gist, what I was saying was that COVID kind of took everybody by storm, if you will, for lack of better terms, or a tornado, and it just shook us up like a bag. And people are just expecting, okay, it's over. Let's get back to where we were. It doesn't work that way. The world doesn't work that way. We're still, the supply demand is still edging through. The China is just barely, scraping by right now.
Yeah, that's been.
They literally, yeah, I mean, they're not doing great at all. They're acting like they are. They're not. Japan has just finally got. We'll talk about Warren Buffett in Japan. I can't wait to get into that topic. But yes. Banks, thank you. The banks, I forgot about the banks. Thank you. The bank debacle. I mean, we've seen a lot of stuff happen. So we can't pretend, and we can't think like, we can't not have a long-term memory. We don't just have short-term memories. The markets don't either. So we have to take all that into account. I mean, we just saw Fed data on yesterday, where expenditures are up 300%. Meanwhile, the GDP is half of what it was supposed to be. Yeah. These numbers are just out of whack right now. Why would you think they wouldn't be after? I mean, imagine somebody took you, spun you, shook you, just totally bent you out of shape for 3 years, and then said, oh, there you go. You know, it's a mess. It's a mess. So again, I think a lot of that is reflecting and manifesting itself in the stock market right now.
Yeah, well said. What are your thoughts, Jeffrey?
Well, I listen to Roger there, and I have to agree. It is an option like seller and option traders type market, but it's very much a stock pickers market. You can't just be blanket throwing your stuff out there, selling it every day because you got to watch for the volatility spikes and sell those. VIX has been the lowest it's been in over a year, getting ready to be 2 years, and we're looking like that could be a hazard out there that traders aren't prepared for if we get a volatility spike, if you're sold too close to the money. So you really need to be very careful and take opportunities that present themselves, not just any opportunity. It's really a strategic market. I haven't seen this in several years, actually, where you had to be very careful about where you put your money because you can lose it just as fast as you can make it. It really does play to have a game plan and be smart about what you're picking. And when we get to my segment, I can show off some of the debt ceiling and bank data that we have and where I think the next shoe might drop in that whole situation. So where do we want to go next here, Celeste?
Yeah. Well, let's talk about before I want to get over to kind of Japan and Buffett, and I can't wait to hear what you're going to say, Jeffrey, about all the debt ceiling as well too. But I want to know what. Now I just lost my train of thought here. Oh, sectors.
Warren Buffett in Japan. Warren Buffett in Japan.
How do you? Well, I know where I wanted to go was with sectors. How do you, with all of this that we're talking about, how can we look at sectors to kind of get the best low-hanging fruit, so to speak, or do we stay just like with an SPY or QQQ? Kind of briefly, what are your thoughts on that? How about you go first, Roger? Or no, go ahead, Jeffrey. You were starting.
I was going to say, I look at the rotations. We do have quarterly rotations, and you can watch the money flow. And right now, I think the moral hazard is banking, and we kind of skipped that, and then front ran big tech, and then we start going into the healthcare and the other sectors, the energy. ExxonMobil just posted their record biggest Q1 profit ever today. I mean, that sounds more like coming out of a recession than heading into a recession. But maybe that redefinition of recession I just don't understand. But
I think everybody's too focused on this recession. I think it's just. I think it's all just a shakeout from COVID that has to happen. Again, I think it's not a great time to label things. I think we are in a new world in terms of stock, in terms of what we're seeing, and everybody's trying to go back to what it was. It doesn't always work that way. This is just, we're in a different economy where algos are controlling 80% of the trading, and it's just there's too much money in institutional money like 401k. The markets are becoming more efficient, and because of that, we're seeing a lot more choppiness and a lot less directional bias. Which, by the way, any market, historically speaking, any market that the more mature a market becomes, the more it goes from being a trending market to a counter trending market. If you look at cryptos right now, they're just starting to get there. Same thing happened with commodities. Same thing happened with currencies. It just takes a lot of time, but eventually markets become, they go from being directional to trending to just kind of being much more choppier and non-directional. And I simply think we're going to go deeper in the stock market index with all of this computerized trading that's going on right now. It's very hard to cause the market to trend like it did in 1987 or even 2008. It's a whole different world since that time, and I think that a lot of traders need to take that into account and take the fact that COVID was had a big impact on the market, and we're still going, it's going to take us a long, those two factors, that the markets have changed from being a lot more trending to a lot more counter trending, and the fact that we have to give things a little more time to settle down from coming out of COVID. And I'm being very broad here, but there's, as Jeffrey said, there's tons and tons of opportunities right now, a lot of opportunities, and it is a stock pickers market. And again, I'm not saying we're going to go and drop 5,000 points or go up five. I'm just simply saying the best stocks are going to do really great. But one of the cool things about this market, unlike 2018, if a stock is really moving right now, the odds are it's moving for a right reason versus 2018, where Etsy was moving and making or Petco is making a 52-week high. And so it's easier to see what's really cooking and shaking and baking versus what's just kind of moving up as a sympathy play.
Exactly.
Right.
Yeah. Go ahead, Jeffrey.
I was going to say, I think what you're seeing is a lot of these companies, like your Petco's and your ARK fund stocks that have been running on borrowed money. You're seeing them have to pay the piper at this point, and they've been punished for it as money got more expensive. You can't run a company at a loss right now because the financing environment just isn't conducive to that kind of operation. And you have whole generations of CEOs and management teams that have never operated a business in an environment where money was expensive to borrow and obtain and use. It was always free flowing. It's been free flowing for 20 plus years almost, with little hiccups along the way, but it's always gone right back down. And that's what everybody's harping on and expecting right now. And I have a feeling we're probably going to hold, as Roger said, and then maybe go through more expansion on the interest rates. It could, we could churn a little bit and then take off again. So, and we could see this reflected in the stock market. We could see it reflected all through our lives. We could see it reflected in inflation, where we just hold a little bit and then inflation kicks off again. This could last a while. I mean, it could last a decade. It really could.
That's what Paul Tudor Jones predicted a year ago, and Stanley Druckenmiller both predicted about a year ago. Maybe, as I say, time gets away from me. It might have been probably more than a year ago. They said that we're going to be in an inflationary environment where commodities are going to trend like we haven't seen in a long, long time, and stocks may end up doing on a inflation-adjusted return. They may not be doing anything for a decade. I don't know which one said it, but they both said something very, very similar. So and that's what I'm saying. Don't necessarily think that the market's going to skyrocket or it's going to fall apart. It just may not do anything. And that's fine too. We can work with that. But that's a scenario we have to take into account, because if you take a poll, most people are expecting it to skyrocket or fall apart. Nobody's expecting it to just kind of not do anything. But that's a big, there's a big chance of that.
That's so well said. And, so the need for traders and investors now more than ever to be able to have education in the market and to be able to learn how to do some trading, shorter term trading, because the returns potentially are not going to be there, I think is fantastic. But hey, speaking of this new world, so to speak, okay, let's switch over to hey, why is Warren Buffett so interested in Japan? What's going on there? Japan versus China, what are the opportunities for us, in your opinion, looking at this whole world, this whole global thing? What do you think, Roger?
Well, interestingly that you mentioned this topic, because it's something that I did a report on for the live VIP room. And it was a very interesting topic. And so here's let me for those of you who weren't there, let me shed some light on you on what Warren Buffett is doing and why he's investing in Japan so much. Warren Buffett is a cheapskate. Yes. Let's just start out there. He's a cheapskate. He loves bargains. And I don't want to spend 20 minutes on this topic, so I'll just kind of cut to the chase. But the bottom line is this: Warren Buffett, last month, Japan got a new prime minister, okay? And this guy's an MIT grad with a very different philosophy on how interest rates work than the previous dude. Let's just say that. And he is going to the way he's going to do things is he's going to not focus so much on the export angle. And that makes sense, because you can't beat China and all these other third world countries like Vietnam for all that. But what he's doing is he is going to start raising rates. He's going to try to make Japan a wealthy country before focusing on exports again, which is what they should have started doing about 20 years ago. But that's not here nor there. So when the yen they're going to start raising rates, and the yen is going to start rallying, and it's going to make commodities more expensive. So you're probably thinking, well, why is Warren Buffett investing there? I'll explain to you why. Warren Buffett knows exactly the same thing that I'm telling you right now. Okay. He knows this very, very well. And he doesn't buy stocks using cash. He buys stocks using margin. And he knows that interest rates are about to go up. So he's buying up things like there's no tomorrow so that he can save and get a great margin rate, because for him, margin is a huge part of his alpha. Now, but then you're probably asking, but Roger, fine. Okay. So he's going to get margin cheap, but if they raise rates and if yen goes up, it's going to be bearish for the market like it was for the US market, right? Yeah. That's true. But have you looked at the top 5 companies that he's buying? They're all commoditized companies. They're all the stocks that he has, the Mitsubishi, all of them. I don't have a list in front of my face, but every company, he has 5 holdings, and every one of those companies is a trading company. It's commoditized trading. So, and parts, fertilizer, metals, all those things, they go up when commodities go up, not down. So Warren Buffett is positioning himself to take advantage of a beautiful mega trend that's going to happen in Japan over 20 years. And he's getting into companies that are going to be driven by commodities, not by their stock market. He's in the top 5, like Mitsubishi, I don't remember the rest, but there's a list of them, and I can give them to you guys later. But that's what he's doing, and that's the reason why he is doing that. So he has a very, very specific, clear-cut reason for doing that.
Good.
And it makes perfect sense if you put all the pieces of the puzzle together.
Absolutely. You mean he's not just doing this all by chance, huh?
No, he's not putting he doesn't do anything by chance.
No, he's not.
He is a very clever guy, and he knows exactly what he's doing. And that's the reason why he's jumping in head first right now.
Time to pay attention. Well, so Jeffrey, what are your thoughts on that? You know, Japan or any global markets? What are you seeing? What are you thinking about?
Well, I mean, is there opportunity? Sure. Are we able to play in that same realm on the same time frame that he is? I'm not. I'd rather be a trader than try to be focused on how I'm going to make return in 20 years from now. And he's playing his end game for his successors, not even for him at this point. He's openly said that sort of thing. He's positioning the company for his successors. And, that's not my time horizon. Yeah. But, it's not that I can't sit here and talk about it and agree with it, but I don't feel like I have opportunity in that realm right now because I don't bring the leveraging power for negotiating and stuff like that. So while it's fun to talk about Buffett and, the deals, I mean, look at, Occidental Petroleum's performance since he started buying. Everybody's like, oh, we got to follow Warren. It's going to go up like crazy. Again, he's trading like a 10, 15 year time frame, not next month, next year, is not going to go up suddenly because Warren Buffett just bought $1 billion. I mean, so it is one of those things that you've got to be cognizant of your time frame versus the time frame that you're trying to take advantage of, just to bring it back to how we can actually make money off of something like that. I feel like the opportunity maybe isn't as readily accessible for the average trader as somebody like Warren Buffett, or that caliber where you can push $1 billion into something and it's not even like a thought.
No, but I'll tell you one thing, Jeffrey. The Japanese yen, once it starts moving, it can start moving, and that's that's something we could trade right here with option, very liquid option.
Yeah, I mean, you can jump on FXY definitely, but that's again, that's part of the bigger story with the interest rates and stuff. But I want to take the small pot shots, not necessarily try to catch the big,
of course,
big trend and suffer through the pullbacks and all that. So,
and I think the point is too, is like, hey, like do what you're comfortable with, make money. The important thing is that you're making money and that you're not losing money. And because there are a lot of opportunities. And one thing we can even talk about too, is like from a global perspective, how about Apple stock? I mean, yeah, it's a US company, but it's like impacts the whole world. You see like in China, the sales were declining, but Apple is now doing this savings account. And Apple has earnings next week. So just small number next week on a Thursday, another Thursday coming. What are your thoughts on Apple? Jeffrey, do you have any thoughts on Apple?
Well, I mean, it's the biggest company in the world, period. It's it's the global behemoth, and there's very little Apple hate out there actually for being such a large company. I mean, when Amazon was rivaling the biggest company in the world, there was a lot of Amazon hate out there. You don't see that with Apple as much, and as it's broken up higher, it looks like it's actually already done its full correction, and it's probably heading to like a $200 price target. I've been saying that for a few weeks to my private members. And, that doesn't mean we won't see a pullback next week. The bigger news next week with that Apple earnings is the FOMC meeting and the rates. So, I mean, both of these are going to play big time into what happens next week. So
Another little small thing.
yeah, just a little small thing we're not even talking about is the FOMC rate raise that's, coming out next Wednesday. So,
oh, wow. Lots of fun. How about you, Roger? What are your thoughts on Apple? And then also I want you to go in. I wanted you to start sharing with us some of the seasonality that you're seeing in the market. So, but what are your thoughts on Apple?
For sure. Well, it's very interesting. This I don't have an opinion on their earnings because that's a 50-50 play. I don't play earnings. I've never done that. I'm not going to start now. But and I agree with you. I mean, it's huge. It's going to have a huge impact on the market, and it does look like it can go up to 200. I agree with Jeffrey's technical perspective as well. Actually, it was one of my top stocks just a few days ago, maybe beginning of this week. Again, time just gets away from me. But this Apple account, savings account, is very interesting. I did a little research on it, and it's really clever how they've done the whole thing, Celeste. So, in order to get the savings account, you have to have the Apple Card, right?
Uh-huh.
And in order to have the Apple Card, you got to have an Apple device. So in order to have the savings account, you have to have an Apple device, which I think is kind of sneaky. Now, most people, I don't want to say most people, I'm general, like in my family, the ladies do Apple, the boys do the Samsungs. So that's just how it is. Not for no reason, just that's how they like the Apples, and I guess they chat on a device I don't know. I don't get into it. I'm not an Apple guy. I've never been an Apple guy, except for the Apple TV. I love the Apple TV. I'm on that all the time, actually. But I think it's a very cool. I think it's a very clever way to kind of dip their toe into the financial market. I think it's interesting, and I think ultimately they're not doing this for. I think if it works out, they'll be dipping their toe more in the financial market. But yes. I think they're doing this more to attract more clients into buying their. I think it's interesting. I don't know how much mileage they'll get into it, but I do think it's interesting. I'll just leave it. I'll leave it at that. I think it's very.
Yeah, they started with the Apple Pay. I mean, that was kind of their first thing, and then Apple Card, now the Apple Savings Account. They're really trying to shave a piece of that transactional volume that happens with Visa, MasterCard, Discover, Amex. There's literally trillions of dollars get transacted there, and they just want their little piece. Yeah. Just like they get a little piece of all the App Store revenue and all the it's all a big plan.
Right. I think that's what I mean. I think it's it's definitely part of something bigger. They're not trying to go into they're not going to try to uproot Charles Schwab. You know what I'm saying? So it's interesting. I think it is interesting. All right, let's talk a little bit about seasonality and about all the other things I wanted to talk about. Okay.
Perfect.
So let me go ahead and share my screen if you guys don't mind, and Please. We'll get right into it. So what's interesting is when I'm looking at my sectors right now, there's a couple of red flags. And if you look at the QQQ, whoops, can't find QQQ. What kind of a charting program is that, right?
Yeah, right.
All right. You guys can see my screen, right?
Yep.
Yes, sir.
Okay. So the QQQ right now, let me get rid of this thing here. Okay. If you look at the QQQ, we're getting near that upper level right now. And I think in terms of earnings this week, we may have some more follow through next week, and we have Apple and we have the Fed. But right now, this to me feels like a danger zone because, as I said, the Dow is very choppy. And let me show you why I feel this way. The Dow, first reason is the Dow and the bonds, as I showed you earlier, are both very, very choppy. There's not a lot of directional bias there right now. And even if this goes a little higher, which it may, there's a lot of resistance here. And again, I'm not really seeing a major catalyst, and earnings next couple of days, and that's it. It's behind us pretty much after Apple reports. That's going to be about 170. We'll be about halfway done this week. We'll be about 3/4 done next week with earnings. So I don't think there's a catalyst to take us much higher. Now, here's the other problem. Look at the technicals on XLC, the sector that's been really propelling the market higher. It's also right at that level right now. Right at that level. Now, if you look at the sectors individually, and if you look at communication services, which is the sector we were just looking at right now, it's bouncing off the lows right here, but typically once it hits this level, it doesn't hit it again. It doesn't go back and forth right away. It usually doesn't happen that way. These clusters, this kind of peaks out. Also, if you look at the other sectors that are inside the Nasdaq 100, see how it's trying to rally, but the last time it rallied a few days ago, it didn't do it. So it looks like it's fading out. It's not really moving up that much. So to me, let me just make it a little clearer. To me, it looks like this has peaked out. So I'm very nervous right now, and also momentum levels right now are not that great. They're kind of in the middle of things. So I'm not seeing, even here, they're just not. Communication services is right in the middle. Technologies at near kind of doesn't look like it bottomed out yet. Consumer discretionary. So I'm not really seeing anything really crazy going on right now. And it looks to me like we may be at the upper end of the range. So just be very careful right now, because there may be a turning point to the bottom of the Nasdaq, and we may be going as high as we're going to go before turning back down. More choppiness, more consolidation, and not a lot of directional bias. Now, the next thing I wanted to mention was earnings. Earnings. Now, so far that we've come out with about 40% of the earnings. At the end of today, we're going to be down with about 45, 46%. 81% has beaten earnings estimates. 75 have beaten revenue. That's a lot better than what we expected so far. So it looks to me like earnings are overshadowing the mixed messages we're getting from the Fed, from the FOMC, and from the not from the FOMC, from the GDP and from consumer confidence, because those numbers were completely contrary to each other and they didn't make much sense. So to me, I think the best of earnings has already come out, and I think from here on out, it's just not going to be as pretty. It's going to get a little worse. I just don't see this level of sustainability hitting us, and I'm not seeing the mid caps moving higher. So I think the Russell kind of sees that coming, because the Russell starts reporting after next week is over or behind us. So that's the second thing that's kind of saying the same thing, or giving us the same picture. Now, the third thing, let me just show you real quick. Here is a graph of seasonality. Whoops, let me just grab it here. There we go.
There we go.
You can see that, right, Celeste and Jeffrey?
Yeah, perfect.
Yep.
Okay, good. So as you could see, now this is starting, next week is the 30th. This, the S&P, this is the whole S&P. So the 30th is right here. Looks like we kind of start swooping for the remainder of the week, right? It doesn't look all that great. Utility, consumer staples looks good, but look at infotech. Look at consumer discretionary. Starts out the week pretty strong and then craps out. Look at technology. Not bad in the beginning of the week, but also looks like it peaks in the beginning of the week. Looks like beginning of the week is a peak to a lot of things. It doesn't look like it's, and by the way, that would also go inside with the fact that Monday Monday turnaround, the
Yep.
Tuesday turnaround. It kind of, now that I'm looking at it, it kind of all goes in hand with that as well. But
Exactly.
I'm not seeing any major strength after next week. Nothing crazy. Now, I am seeing some doozy seasonality trades that I wanted to show you guys today. And I'll do that right now. These are here are the long seasonals for the week. Not for the week. This is getting in at the end of the day today and getting out. Aside, you don't get out today, obviously, not day trades, but you would get out when it takes out the previous day's high near the end of the day. So here are some trades. This is 23 trades, and here's the win rate.
Nice.
95% win rate, 93, 91, 91, 91, 90.48, 21 trades. So this is let me make it bigger right there. There you go.
There you go. Yeah, that's better.
So there we go. So you could see here, we got, if you guys want, you could take a screenshot. So T-Mobile, they're looking at, out of the last 11 years, it made money 10 times, and the profit factor was 36 to 1.
Very interesting.
Yeah, there was a industrial stock, Chevron, pretty good. Look at that, 23 years with a 95% win rate.
Mm-hmm.
I think they had earnings today, by the way, and a profit factor of over 10 to 1. Over 23 years, Celeste, isn't that 95% win rate? Pretty good, right?
Excellent.
INCY. So here are the stocks. We got TDG, PKI, and you would get into these at the end of today, and you would get out of these when it takes out yesterday's high at the end of the day, excluding today.
Interesting.
So that's the first thing I wanted to show you. Now let's do the short side. Got to do the short side, right? These are the worst stocks. And it's interesting to see which stocks are on the list. I'm actually thinking of taking this one by the end of today, AAP, in one of the programs. Probably said more than I should have already, but
Yeah.
This one looks really juicy right here. AAP, 15 trades, 3.65 win rate, 86%. But you can see here's the number of trades, and these are all to the short side. So for example, Expedia, not Expedia. I thought it was Expedia. What's the one with 19? RE, Financial Services. In the last 19 years, it had 84% win rate plus with a 1.7 profit factor. Since 1995. That's like out of 21 trades, it won 19 times. So, but here's what we're dealing with. Feel free to take a screenshot. But looking at seasonality as a whole, next week looks very, very mixed. And that's all I've got for you guys for today.
That's fantastic. That's a lot. We'll take it. We'll take every little bit of it. Thanks for sharing all that, Roger. Let's keep moving. And Jeffrey, what do you have? You piqued my interest. Debt ceiling. That's been a hot topic. We're talking about the next shoe to drop. What do you see?
Yeah.
Fill us up.
Let's start with since Roger got the ball going on seasonality, let's just talk seasonality a second. And I'm going to start out with volatility seasonality. This is VIX chart for the last 20 years. I like to use 2 decades of back test data and kind of put it together on a lot of my stuff, as Roger's heard me talk about recently. When I look at this right now, we kind of went through a little spike and a drop into the end of April. That's exactly what happened on VIX, if you look at the chart. And now we're looking at heading into May, and we're probably going to get a little bit of volatility before, the last week or so of the month. We might dip down lower than we are now on VIX. So this is something to keep in mind. We may see a little volatility coming to the market, some pullbacks, some bigger outsized moves. If you're short those options, you're short some spreads, you might want to be careful. This volatility can cut both ways. We can see big ups and big downs. So selling bear call spreads or bull put spreads, not necessarily the smartest thing to do if you're close to the money. You've definitely got to pick your spots. Wait for the days that are big ups and sell your call spreads. Wait for the big days that are big down days to sell your put spreads. That's my guidance for the next 3 weeks or so as we look into May. As we look into the end of May, the situation may improve, but remember, in June, we also see some bigger spikes before July, things calm down again. So it's definitely one of those things where you need to pick your spots when you're selling spreads. If that's one of the things you like to do, which I have a couple services that I like to try to sell premium.
Excellent.
Looking at the S&P seasonality, as you kind of kicked it off, Celeste,
Mhm.
we might see a little chop and little sideways sell in May situation, and then it can be sideways pretty much through July.
Mhm.
So we may see a little up and a little down, and an expansion of range as far as the volatility goes, which fits with the volatility charts, and then be right smack dab right where we are as we head into July. So I'm kind of prepared for maybe some movement, but maybe some sideways action for the rest, through at least midsummer. All right. Popping on to the next thing. As I was talking about this, we were seeing 7.7% at the peak. We've kind of moved into this second act, probably, where we're getting this premature all clear. This is by Bloomberg right here. That's kind of the story we're getting right now, that, hey, inflation's all clear, right? But then we could see inflation come back with a vengeance. These are number of months on the bottom since the start date. We're probably sitting right here around 36 months since we started this inflation party back before, 2021, 2020 is when the problems really started kind of kicking off. So we could see this kind of all clear, the number came in a little high, the number came in a little low. And then, oh my gosh, we don't have control on this at all as we get on out here into the decade of sideways markets. So
how do you read that bottom line there of the dates? Like, what is that 155 all the way? Yeah.
Yeah, these are number of months from the start of the inflation.
Got it. Thank you.
So, we kind of started inflation back in that 2020, 2021 timeframe when prices started kind of going up, and we were like, oh, and they're like, oh, inflation's transitory. It looks like we're going to have this for a while. This would be 155 months out here at the end.
Mhm.
So from the start of that. So, thinking about that, that's going to lead us into the 2030s. So.
Yeah, that's what I was trying to oh my gosh.
Putting that in perspective for everybody. So inflation is probably something we're going to be living with for the next decade or so. If you thought it was all clear, I'm sorry to bring it to
No.
Bring it to us now. Let us know now, so we can all be prepared. I've been hearing this myself too. So good.
Now,
stuff.
circle it back around to the debt ceiling that's making the news like crazy. Last week, I was talking about the fact that it looked like IRS receipts were going to come in 30 to 35% light. The shocker after the close on Friday when the DTS came out, that's the daily treasury statements, 37% light year over year. Where did all that money go? I thought the administration was saying that we were more employed and had better jobs than we've ever had, making more money. Well, that's not what the tax receipts are saying. Based on, I don't know about you, Celeste. My taxes come out before I get the paycheck, before I pay for inflation, not after. So this is not an inflationary side effect. This is people getting paid less money.
Yeah.
And those tax receipts coming into the government are light.
Interesting.
By 37% year over year. So this is actually this was a worst case projection right here showing a July, and it actually came in worse than this. So the blue line is actually higher, which means that this peak in mid-June could be when it hits the red line and we hit the debt limit.
Interesting.
That's something I've got my eye on. This was from Goldman Sachs Treasury
very cool graph, by the way.
Investment service here. So the green is the cash balance of the Treasury, and the blue is the extraordinary measures that are scheduled to be running out here in May.
Mm-hmm.
So this peak right here, as we come into mid-June, could be the point where we hit the debt limit if they don't actually take action. So this is what does that mean for the traders? Well, the last time we really had this situation was back in 2011 in August, and it caused a big freak out in the market, and we dropped many percentage points. And if you want to go look at the charts, go look at the charts. You can see what August 2011 kind of did to the market. We could see that kind of problem again if we actually start hitting that debt limit in a real way. So it's something to keep an eye on. That is a threat to the market.
Very interesting. Very interesting.
Now, to circle back to like the banking problem I alluded to, we have CRE, which is commercial real estate, if you're not familiar. And there is a lot of commercial real estate that the bills are coming due.
Yeah.
And we've been kind of in a low market. Lots of investment was taking place in 2018, 19, 2020. We kind of slowed down. And then, back in 2020, you had 5-year notes and 10-year notes, before that. Well, those bills are going to be coming due here in 2022. 2022, you see a little spike. 2023, 2024, 5, 6, 7 is when they really get going. And if we keep a high inflationary environment where the rates are higher, refinancing that debt again is going to be expensive. And one of the ways I'm playing that right now is short ARE, which is a real estate investment trust that's highly leveraged into commercial real estate, CRE. So that's the way I've played it. And just, completing the circle here, the way that CRE ties into the US banking system, there's about $4.5 trillion in US commercial property debt tied up in loans currently in the US banking system. So this is this is a lot of money that is threatened with CRE. And when you're hearing all this, I don't want to return to the office type talk, and COVID changing the world and offices being vacant. All this is going to come into play as the CRE environment, commercial real estate settles out. So that is a threat to the market and something to be aware of. Now, while we were talking about different things there, I was looking at the Russell. It is coming off the bottom and showing a little bit of strength. A lot of the small cap regional banks were in the Russell, and the Russell outperformed to the downside here in March. And it's just been kind of consolidating sideways since that, since the fallout of that banking crisis. Now, there is opportunity for this to recover potentially, but we could also go down further. I did put this big blue arrow as an extension possibility. If we break out of the bottom of that range, we could extend lower. If we start breaking back above 1850, then we could potentially rally back up into the 2000 area where we peaked back in February. And this one kind of led us down into the banking crisis. And that, if you're unfamiliar, I just have the Russell 2000 stocks up, and that's IWM would be the ETF for that. One other thing I want to talk about, last week I was talking about the potential for either to break down or break up. We pulled back, and now we're pushing higher on the S&P 500. That 4,300 retest that we saw where we topped in August, I feel like that's a high probability kind of event at this point, that we're going to go up there and retest that and then get a reaction. And another way that I've played that is by taking the SQQQ, which I see a retest here, and I actually bought a put on the SQQQ, which, SQQQ is short QQQ in a leveraged way. So I bought a put on that out to mid-May, the May expiration, May 19th, I think it is. I just bought it at the money, and it cost me about $1.45 today, looking for that last little pop on NQ. And then at that point, we're probably going to get some volatility. I mean, the VIX seasonality shows it. The S&P 500 seasonality shows it. I couldn't find my Nasdaq seasonality chart, but it also shows it. So I would expect some volatility heading into the second and third week of May, potentially.
Yeah, it's a lot of, it's really good. Great presentation. Thanks for all of that, Jeffrey. What are your thoughts kind of on what he was saying there, Roger, and even looking into, May and into the summer?
It just depends if we have a catalyst for it. Right now, I see absolutely zero catalyst for going to the next level. I think we're going to peak out a little bit before there, a lot closer to where we're at right now, and start coming down. But who the hell knows what's going to happen in the next month or so? I mean, I'm thinking next few days, just not seeing it at all. But again, if maybe if the Fed doesn't raise, or maybe if the numbers continue coming out this well, it's possible. I believe the probability is to go south from here, or just consolidate around here. I'm not seeing any major catalyst to go higher at this point, especially after earnings have come out and the best of the best have come out. But again, I've been wrong before. Seeing more choppiness, more negative market. I'm a little less bullish than Jeffrey in the short term.
Yeah,
I'll tell you what the catalyst is. The catalyst is, for me, is the FOMC meeting next week. If he goes softer on rate raises, historically, every time we stop with the rate raises, or put somewhat of an end on it through FOMC announcement language, we tend to kick off a rally. That's historically it's happened.
That's very, very possible. That's what I mean. If there's a catalyst, that very, very possible. I'm just not seeing one right now, but it's very possible if there's a catalyst, for sure.
Well, let me ask for some clarification too, Jeffrey, before I make a really great special announcement. But so like when you're buying the SQQQ, then the SQQ, you're buying a put on the SQQQ,
Yeah,
which is inverse to the QQQ. So it's like if the Nasdaq is going up, the QQQ is, or SQQ is going down. You bought a
right.
put thinking that it's going down, that SQQQ is going down, and thinking that the Nasdaq is going up, and you're thinking that that's going to happen in the next couple of weeks, and then we're going to have that kind of switch over into that volatility to the downside. Was that kind of what I just
Yeah,
wanted to clarify
this
with
is
some
this is kind of
questions.
a short-term play, looking for maybe something in the mid 20s to
Yeah.
even $20 on SQQQ. I've got the chart up here now to actually talk about it. See, we kind of broke this upward trend line right here, and we've broken it definitively. And then I look at what Nasdaq did today on the bounce off of this red consolidation box. You know, it tried to push down and came right back up. I see a rally to the top of that box as highly likely to occur. I mean, there's no resistance anywhere in this chart. It's actually been outperforming on the top. We have kind of a triple top here, but if we break out at all, it's rallying. So this is a light position for me. I mean, it's not, I'm not going in with a 10% of my wealth position. This is like less than 1% risk on this potential for SQQQ to make an extension lower. And circling back over to that chart, left one Q out. It just looks like it wants to get one more extension lower, and the fib lines for this, for this target, probably going to head around this 25, possibly even down to this 18 to 20 area right down here. That's like an extension. I drew these months ago. I drew these arrows with this extension. It's just taking till now to actually play out, and just to take advantage of that potential. So somewhere around 25-ish, and then if we just break on right on through 25, we could see down to this $18 to $20 area on SQQQ, and buying an at the money for $1.40. I mean, that could pay out quite handsomely, 2,
Which
3,
one?
400%.
Can you repeat which people are asking? Which option did you go get?
I didn't screenshot it. I'm so sorry. Let me give
How
me
far out did you
one
go?
second. It just May 19th, I think is what it was. One second, I'm pulling up my my chat room on the other screen.
There you go.
So
We can wait.
it was the May 19th, 2023, $29 put, and I paid $1.44.
Ooh,
Good
big
price.
Yeah, real good price. So that, it's very low risk. Excellent. Good, good, good. Well, thank you, everyone. That was a lot of great content. I'm going to take over the screen share because we know there's just, there's a lot going on in these markets, and we want to have the best opportunities. So let me get here. There we go. Did I get it? Okay. Can you all see my screen? All right. So I get to bring you this special announcement here. We had a great session, and there's always a lot that we want to pay attention to coming into these summer markets. Jeffrey laid out a great case. I love that. With May, we've talked a lot about the potential of things going on in the summer months, but this special announcement here, let's get going, because one of our favorite traders, Micah Lamar, has a special briefing that is about to start in just a few minutes.
Ooh,
So
nice.
yeah, it's going to be really, really good. I love it when he talks about Apple, because as we mentioned, that's like one stock you can follow that's like hugely involved in the whole world, also in the US. And, now they're getting involved in these finances. I mean, there's a lot to know that's going on that would be to our benefit. So he's the genius entrepreneur behind the world's most advanced strategy testing website, wallstreet.io. But what Micah is really known for is being an Apple obsessed trader, right? And he carves out just spectacularly an effective strategy on this world's #1 stock. And he's been publishing Apple commentary. Maybe some of you have read it. I have. It's fantastic. He's done this for over a decade and has used his proprietary strategy software to run through millions of variations of his core Apple strategy. So today, here in just a few minutes, the link is in the chat, go get it. He's hosting a workshop to show you the crown jewel of that research. It's going to be good. A strategy that's so effective at spotting the best trades in Apple that is averaged, get this, 65% return per trade in the last 3 years. That's more than double Apple's stocks annual return per trade. That's pretty fantastic alone. And probably even more amazing, it put up another profitable year in 2022, while Apple itself was considerably down. Quite a feat. Micah is going to walk you through his Apple only strategy today, starting in just a few minutes. That's why we're bringing this to you. So you can go right there. The link is in the chat as well. And here's another link too. Check out the one in the chat, prosperitypub.com/Friday, or it might be this one as well. We've got both of them listed. So just go right to the Zoom room. You can go there right now. We have brought you the best content we could right here for this hour. We want you to go get this from Micah right now. So thanks everyone for being with us.
Check it out, folks. Very good stuff. This is a very, very cool presentation. You guys are going to love it. Do not miss out. Go there right now.
Yeah, I got a couple of things to say about Micah. He's a friend of mine. I actually helped him beta test his current Wall Street IO platform before it was out to the public. Super great platform, super great guy. He actually called his service before it was Wall Street IO. It was Apple Trader. So he specialized in Apple. That he's been on it for years and years. Like Celeste said, over a decade. You know, he specialized in Apple. Now he's Wall Street IO. He's pulled it out to cover all the stocks with his back testing platform. Great platform, great guy, super nice. And I can't say enough about him. He's a great friend.
Yeah, he's fantastic. He is just a fantastic guy. So, and very, very knowledgeable. So just go get it right now. You don't even have to say goodbye to us because we'll know you want to get over there to go see it, and just click that link, make sure it works, and we'll see you right there. The link is posted. So thanks everybody. Have a great weekend. A last day of April. We'll see you next month. Have a good one.
Bye, everyone. Thanks,
Bye,
Jeffrey.
everyone.
Good to see you, Celeste. Bye, guys.
Good to see y'all.
Have a great weekend, everyone.
Thanks,
Bye.
everyone.